on Tuesday. Unfortunately, there was a professional emergency, so I had to leave at the last minute and I couldn't reach back IIT on time. So I had requested for a last minute cancellation. I apologize for that. I hope I'm audible.
Live. Sir, we are live. Sir.
Yeah. Thank you, Ravi.
Audible, sir. Thank you.
This is the last live session, and we are almost coming to the end of the course. And I'm very sure that you would be at the last week of the finance part of it. In finance, as I would have said, there are two parts. One is the sourcing fund part, another is the investing part. The investing part we would have sort of wound up finished by now, and then we are more in the sourcing fund part, the cost of capital and aspects like that. Any queries, concerns, questions? I can always take it.
One question is, there was I remember we earlier spoke about a book. You will release a whole thing as a capsule of a book.
Yeah.
I'm not sure whether that happened. We
there
have
is-
only slides and the Excel sheets as a basic course material, other than the reference text.
Okay. The reference text, I mean, the what do you call textual narration of the whole thing, we are sort of we have promised to release, but I think there's some delay, and we will be getting it posted in the next week or so maximum. I think we have couple of last couple of sessions left. I think 3 or 4 left, which we should be winding it up in the next couple of days, next 2-3 days, and then we should be posting it up pretty early. I think there has been delay. I agree with that, and we will do it as early as possible, sir.
Thank you, sir. At least we'll have 1 week, review with that book, if possible, because going through the whole video takes a long time.
Yeah. We'll try our best to do it as early as possible. I mean, we'll do it, sir. It posted some questions on the Google form. Okay, sure. I think, can you take out the questions, sir? Can you share the screen? Yeah, sure. Last two. Next one. Row 7. 6th assignment, question number 10. And explain how you got the income tax shield. Is the only difference between, one second, let me explain this. Between calculation of payback, discount payback is that discount is the 5 examples. In assignment 12, it took about 4 or 5 tries to finally understand question number 3. How to improve the good performance in the incoming exam. We'll start with the question 6, assignment 10. Can you go to assignment 10? Yeah, sure. Assignment week 10, question number 6. Go to question number 6. Yeah, you can invest in an account that pays a simple interest or an account that pays you compound interest. In either case, you plan to invest on 2100 today, and both accounts have an annual interest rate of 5%. How much more interest will you earn, will you receive in the 10th year if the account that pays compound interest? Very simple example. Can you stop sharing the slide? Very simple example. For example, I invest 100 rupees and I'm looking at a simple interest. That means I earn 5 rupees at the end of every year. So for 10 years, I earn 5 rupees at the end of every year. Whereas when I say compound interest, what happens is the first amount in the first year on the 100 rupees, I earn 5 rupees. For the year 2, the principal is 100 plus 5, 105 rupees. On that 105 rupees, I will earn an interest. So what happens? The amount of interest what you will earn will be more than 5 rupees. And for the third year, what happens? The 105 plus the interest that you earned in the second year will also be added, will become the principal, and you will earn interest on that at 5% out there. So overall, every year, the amount of interest what you get, barring the first year, will be more than rupees 5 in case of a compound interest, because your principal every year is not the same 100, it is much more than 100. Whereas in the case of a simple interest, the principal remains constant. The principal doesn't change. That is the difference between a simple interest and a compound interest out there. I hope I'm clear, Mr. Ramnik Singh. Can I stop sharing the screen for a minute? Can I stop sharing the screen for a minute? So that I can see the chat window? Yeah. I hope I'm clear, Mr. Ramnik. I hope with this question. Let me move to the next question out there. Please share the screen again. You're talking about the tax shield out there, number 2. That is a question, is the tax shield out here. Again, stop sharing. When we talk about tax shield, what happens? I am taking 2 cases. I would have taken most of the examples, what I've taken 2 cases. One is with debt, and is without debt. When there is a debt in the capital structure, the amount of interest that you pay on the debt is always pre-tax, before tax out there. Supposing I have 2 cases, case A, case B, the capital is 100. In case A, the entire capital of 100 is equity. In case B, the entire capital of 100 is divided into 60 equity and $40 in the form of debt out. The capital is 100. But what happens? The amount of tax I pay in case A, supposing I earn a profit before interest and tax of 10 rupees, the amount of tax I will pay will be on that entire 10 rupees. Whereas in the case of B, supposing I pay $4 as interest on the debt and I earn 10 rupees, what happens? $4 goes away, and what happens after paying the interest? Only $6 is left, and I will pay interest, I will pay tax only on that $6 out there. So I am saving on some tax. What is that I am saving? On that $4, what I paid as interest, I am saving on the tax part of it. That is what we call it as the interest tax shield. You are saving on the tax part of it. And that is what we call it as the tax shield. Share the screen again. Share the screen again. Let me go to the third question. Third question, what he has got. Yep. Yeah. Now, third, the only difference between calculation of payback and discount payback is that in discount, we have to multiply the cash flow with PV of the cash flows. Yes, that is the multiply the cash flows with the present value of the cash flows. Yes, perfectly right, sir. Your third question. Fourth, I found last 2 assignments a bit tough. I could not understand questions in a few tries. For example, in assignment 12, it took about 4 to 5 tries to finally understand question number 3. As we go further, the assignment slowly keeps getting tougher. I don't deny that. In the first assignment, what you would have had in the accounting, assignment would have been very easy, cakewalk out there. Let's share the screen again. Assignment would have been a cakewalk out there. But as we progress through the course, naturally, assignments are bound to get a little tougher. I don't deny that. That is because I believe that you would you would have developed that inherent skill by now to understand and comprehend these things out here. One of the ways possible you could do is try and see if you can do more examples from the prescribed textbook, possibly, or any other textbook, finance textbook, I would say. The fifth is also doing examples in Excel is still good, but I get much slower when I practice offline. I think that is perfectly all right. I mean, you might get a little slower. That is perfectly all right, sir. But as you go along, as you go on practicing, I think things improve, because as you go on comprehending the logic, I think things improve a little bit. I don't think you need to worry about that, Mr. Ramnik, as of now. The next one, sir, in one of your lecture, you told us that the pecking order theory firms prefer to issue debt rather than equity if internal financing is insufficient. But I've read that in pecking order theory, it is assumed that managers know more than the investors. Is it true? Yes, in a way true. If yes, then why is it assumed that managers know more, as it is common sense that managers would obviously know more than investors, as they are the one inside the industry? That's okay. Don't now stop sharing the screen. In pecking order theory, they prefer more debt, because what happens is the equity, if you sort of capitalize your firm by issuing equity, your equity, number one, is getting diluted. Number two, your holding, the percentage of your holding, your shares are not increasing, but the overall equity is increasing. So what happens as an owner, my share, a percentage of holding in the firm is basically coming down out. In a debt, there is only a fixed obligation. That is what happens when, like, my company is cash rich, I can repay the debt and then keep control of the firm. And if the firm is going to make more and more profit in future, the entire profit belongs basically to me in the process. I don't have to share it with anybody, number one. Whereas in a debt, what happens? I can give them a fixed rate of interest and be done with it. So pecking order theory, we normally talk about if the future prospect is going to be great, etc. I don't want to share the booty, so I want to keep it to myself. So I would go in for a debt, because it is going to be for a short term. The obligation is going to be for a short term. The payout is going to be fixed out there, and the future performance, when it is getting better, I am going to control it, and I'm going to generate more value for my holding in the process out there. That is where pecking order goes in. And what you said is true. Managers are pretty much aware of it, because that is always a difference between insider and outsider. And that is where we have the classic agency theory or agency problem. I did talk about agency problem, I think, in one of the last classes out there. Agency problem is the amount of information that the insider has is always different from the amount of information that the external person has. And that is what gives you what is called as the agency conflict. That is a very classic documented conflict out. I hope I addressed all your questions, Mr. Ramnik Singh. Yeah, I see your chat. Due to Shakshi, debt is cheaper than equity. Yes, in a way, yes, debt is cheaper than equity, because what happens is you don't have to share the profit. If your company is going to make huge amount of profit, your debt cost is always there, and debt is always cheaper than equity because of the tax shield also. Yes, of course, yes. Thank you. Am I with you now, Mr. Ramnik? Okay, sure. Thank you. Now, any other question? Harshdeep Kaur?
On week number 10 assignment, question number 2.
Ah.
In fact, I had posted probably yesterday's queue also question on that. So basically, when we that question asks about interest rate, if you what is the
what is the
question number
present
2?
value of
No, of
6,800?
week number 10.
Week number 10. This is week 10. Week 10 assignment.
Yeah.
Number
Question
2.
number 2.
Ah.
Uh,
This is a question, sir.
no, not this, sir. I think
Not
I'm
this.
mistaken. Probably.
Okay.
Let me check that 1 second, sir.
Sure,
You
sir.
continue with other
If you have
questions.
already posted a question, I'll respond to it, sir. Not a problem.
Yeah. Sure.
I'll respond to it. I'll respond to it by end of the day today. I'll do it. Bring it down. Stop sharing it. On the assignment question, if you shared it, I'll respond it by today evening. Any other question? this transcripting is taking a little more time than we anticipated. Because what happens is we'll have to listen to the lecture, we have to document it, then again listen, then again edit it. So unfortunately, that's taking a little more time. That is why there has been a delay. And we'll try and post it as much as it's ready. We'll try and keep posting it within a week or so.
Sir, I have one question.
Sure. Go ahead,
Sir,
Mr.
it's from week 11, question 4.
Ah.
Actually, I'm getting a bit issue in the answer. It was 12.48. I'm getting 11.48. So I was just confused regarding the solution.
Yeah, I'll just check it up. In the
Sure.
meanwhile, I'll just go to the chat message from Ms. Samnik. One more for now.
Okay.
I have in term. I think both interim exams, you can sort of, this exam is going to be more conceptual. So you don't have to really worry about what Mr. Ramnik saying. So if you have paused the lecture, you have tried to solve the assignments, I think that should take care of it because the exam interim is going to be more or less in the same pattern out there. Yeah. Question number, week 11, question number?
It was question 4, week 11 assignment.
Four.
Yes, question 2. Yes, I got 11.48 here.
Paid a per share annual dividend of 1.50. The company is planning a share over the next 4 years, respectively, after the dividend, and a constant of 2 rupees out there. So, what is the market price of the stock if the market rate of return is 5%? I can just share the solution.
Sure.
I can just share the solution also. You can just share the solution also.
Sure, sir.
Not a problem. Just share the solution.
Sir,
Yeah.
Sir, on the same week, question number 8. Okay,
Ah.
we can take it later. Yeah.
Yeah, we'll take it, sir. We'll take it. You can anyway, because we are just going to put up the solution also. I can share. Question number 4. Yeah, yeah. That's a question. Can you share the solution, sir? You can see the solution out here.
Okay, sir. I'll check.
Right on the screen.
Yes, sir. I can check.
Right, 1.62. That is what we have basically discounted all these things out here. That's all.
Okay.
You can just take a screenshot.
Yes, sir. I took the photo.
Yeah.
And just one more thing I wanted to ask, that many of the questions we are trying to do, it's mostly from we are using MS Excel. So I just wanted to ask that will we be getting online on-screen calculator, or will be getting the Excel sheet as well?
You will be getting the on-screen, the on-screen calculator. That's what I've been told. With all the functions, you will be getting an on-screen calculator.
Okay.
Okay. Another thing. Yeah. Question number 8. Go to question number 8. Week 11, question number 8. Mr. Ranganathan has a question there.
Yeah. So here, actually, the annual, normally when you talk about return, even if it's for 8 months period, we talk about annualized rate. So, whereas if you absolutely calculate for 8 months, 8.62 is right. You take it annualized. When you talk about percent return, we normally talk in terms of annualized. Correct? So 8.62 is only for the 8 months period.
Okay.
So
but
12.9 or something if it is annualized. So that's my question.
Oh, 1 second. 8 months ago, you purchased 400 shares of Winston, price of 46.40 a share. Company's quarterly dividends of 1.05 a share. Today, you sold all your shares.
Basically, it will be 4 rupees on 46.40, which is 8.62. But that is only for 8 months period, because in 8 months, you would have got 2 dividends, which is about 1.05 to 2.1.
2.10.
Plus 1.90 will be the capital appreciation.
Yes, capital appreciation.
So 4 rupees is what you would have earned in 8 months.
Okay.
If you annualize it, it will be about 12.9%.
But
but absolute return is
8 months, for 8
8.62.
months. Only for 8 months, we are calculating, looking at it, sir.
Yeah, but when you say, when the question is asking, what is your total percentage of
Percentage return
return?
on your on this investment.
Yeah. And normally we talk about percentage and we annualize it, right?
Normally,
Absolute
yes.
return.
I don't deny that. Normally, yes. But in this particular case, I specifically this is how we have worked it out. That's all.
Or we
Not
call
even
it
taken
holding period, right?
holding. In this case,
mm,
48.3 minus 46.4 plus 1.5 into 2 divided by 46.4. That is the purchase price. That's all.
Correct.
So that is all what I've done. That
Yeah,
is
it's more like a holding period return.
Yes, that's all. I'm not even converting it to a year. I'm just saying what is the price at which I bought, what is the price at which I've sold, and what is the interest, what is the return I've earned during those 2 periods. That's all what I've taken, nothing beyond that. I'm not even considering the time period. I'm not even considering the time period here at all.
Okay.
Okay. Yeah. Sure. I'm not even considering a time period. I'm just taken the purchase price, sales price minus the purchase price, and then the dividends that I've earned during the holding period. That's all. If you are looking at, because what is my return is what I'm calculating. What you say, Mr. Kanada, is for the annualized return. Yes, I don't deny that. But then that we call it as what do you call it in this particular, that is not the gain what I'm making. In this case, I want to know what is the gain I have had by holding the share for 8 months out there. That is all what I've taken. In that 8 months, as you rightly pointed out, I've received 2 dividends and a price hike of 1 point something or something, 1 point something, 48 minus 46 something. That's all. Any other question?
Sir, one more question I have. It is the
Sure.
beginning of the early chapters on the financial accounting, cash flow especially.
Okay.
In when we earn interest from a company earns interest or dividend, that should be treated as a
cash inflow because of an investing activity.
Investing activity.
Because
correct.
you have invested money somewhere, you are earning interest. So that is what you are earning interest means cash inflow. Why are you earning that interest? Because I've invested money somewhere, I'm earning interest. So cash inflow because of an investing activity.
Yeah. But the textbook thing, they are taken FASB standard and say sometimes it is allowed to use it as operational income.
Yeah, that is, say, what happens is sometimes where you have parked the money somewhere short term and it is earning interest. It is not an investment per se. You have just, what do you call it, as idle cash, you park it somewhere and that is earning some interest. Where as per the accounting standard, where the motive of parking the money is not to earn what is called as earn interest, not to create a business out of it. And interest earning is incidental. So there it is treated as normally operating. That is what the accounting standard clearly says that. So, but whereas when the company has invested money in a subsidiary, in a holding company, in a associate company, etc., they are all interest from investments out there. Interest earned is investments. Only where you have parked the money for a short while, short term, something, etc., sometimes the companies do treat it as operating income because the objective of parking the money there is not to earn main interest out there. That is not the primary motive in that case.
So, to be on the safe side, if we include it as a investment expense, it's okay, even if it is a short term.
Yes, if you include it as an investment expense, investment income, it is much more, you are more correct. That's all.
Is there any reference on this from Indian standards?
Indian standards, accounting standards also talk about the same thing, sir. If the motive, the purpose is not basically invest and earn return on it, if the purpose is a short term and not to earn an interest, for the safe keep, then there is what is called as ambiguity. Some companies do treat it as operating, some companies very strictly go as investment. Both seem to be allowed out there.
But what about dividends will be considered as a long term anyway?
Dividends will always be long term, sir. It will always be investments. Dividends cannot be short term. It is only the interest.
Yeah.
Short term
Okay,
interest.
thanks.
For example, you have an excess fund in your account. You park it for 15 days in a fixed deposit or something. And that interest, normally they will take it as operating. They will not treat it as interest on investment. Because the 15 days I put in FD, because for a safekeep of funds out there, the objective is not to earn interest. That is what they say. Though in stricter sense, the objective is to earn interest.
Thank you, sir. That's
Right. Any other question? Mr. Nimesh? Shubham Kumar? Sumit? Mr. Sumit Pike?
Sir, I just wanted to ask that the date is final, right? 21st April, exam date.
Yeah, I think that is decided by NPTEL, and I think it
Yes,
should be
yes.
final.
And when will we get the admit card?
I will request the NPTEL office to address that query, sir, because
I
Sure.
guess
that
I
is.
guess the admit card has been released. Bit
Uh,
means one course by course.
I think you can post it in discussion forum. They will also respond to it because that is the
Sure.
administration part of it. They take care. I do only the content.
All right. Sure. Sure, sir.
As I had said, as I've indicated in the earlier live session, the examination will have three parts: financial
Okay.
accounting part, cost accounting part, and finance part. In each of it, we will have 8 questions, which will be 6 to 8 questions, which will be purely non-number based, will be only 1 mark per se. And then we have about 12 questions out there, which are number based calculation, which carries about 3 marks. This is the same pattern I've followed for all the three, basically the financial accounting, cost accounting, as well as the finance part of it. And it is the same for whichever, the pattern is the same for whichever shift of the examination you take. I think there are 2 shifts of examination. One is a morning shift, and is an afternoon shift. So whichever shift you take, the pattern is the same. Pattern is not different.
And sir, the whole exam would be MCQ based?
Whole exam is MCQ based, right? Yes. Only one question is numerical, where in financial accounting, where you have to fill in. That is, there'll be 8 fill in the blanks, 8 fill in the blanks, and each carries some half mark or something like that. So
Okay.
everything else is multiple choice.
Sure. And sir, I got
The
one
same
document.
way as my assignments are given. I have not
Sure.
deviated from that.
Yes, that would be great. And sir, I got one email in which there was the location of the center and it was written 4 noon. Time was not written, but it was just written 4 noon. So maybe that's the admit card.
I am not sure, sir. You will just
Okay, I'll post
yeah,
on the
because
announcements.
I do only the content part of it.
Sure, sir.
Actually, there has been personalized mail has been received by the NPTEL, so you can check the link from there.
All right, sure. Thank you.
Welcome.
Yeah. But even the France part, I hope it's clear. I think the last few weeks of the finance part of it, it could be a little heavy as compared to financial accounting or cost accounting. I can say that. But I thought the clarity part of it should be okay.
I think, yes, sir, it was a little rushed up in the last 2 weeks. I remember in your early classes, first class, I think you mentioned you're going to spend 40, 40, 20. I mean, 40 percent of time on the financial accounting and 40% on the finance management,
Ah.
and 20% probably on the cost accounting. In terms of absolute number of hours, probably the last portion was a little rushed up. So I think we had only 2.5 or 3 sessions on finance management. So
3 weeks.
the entire
3
topic
weeks.
was little, yeah.
Yeah, 3 weeks on financial management.
Actually, originally it was supposed to be 4 plus 4 plus 2.
4 plus
I
4.
mean,
Yeah, around because I initially planned 3 weeks of cost accounting, then 3 weeks of 4 weeks of finance, but it got interchanged. It is little heavy, I don't deny that, but the basic concept is what I touched upon.
yeah. And also probably because of that, you didn't have an opportunity for summarizing the course, which normally you would have spent what we covered.
Yes.
Probably one video could have been spent for that. But anyway.
I'll add it, sir. Thank you for the
Anyway,
feedback.
we'll wait for the book that will help us, sir.
Okay, sir. I will add it up for the next session that I'm going to offer. Thanks for the feedback, sir.
So, sir, this same course would be released on the second semester of the second quarter, you mean to say? The
I think
foundations of
this is going to be floated again also. I think they're going to float about 3 times in a year or twice or thrice in a year.
okay.
And it will be floated again. And the same recordings and they will be floated with a little bit of additions based on what Mr. Ranganathan gave me. The feedback, I would add that in the last session. And then maybe extend it by 1 hour or so. And the same thing would be running again. We'll try to get the transcript ready as much as possible, and as and when it's ready, I'll keep it getting posted. I think we will quickly move on that. So, any other question, Mr. Anishka Goel, Kavya, Mr. Lakan? Any question? I can take it. There are questions? Yeah, sure, sir. Go ahead.
One more question.
Sure.
When we talk about, there are quite a few questions where you ask for questions based on dividends in perpetuity, and based on that we arrive at the value.
Yeah.
There we presume that the stock by itself doesn't appreciate when we take it as a perpetuity income, right?
Yeah.
So quite a few samples.
Yes. Because what happens is when we talk about perpetuity, we are not looking at the gain, capital gain. We are looking at the dividend discount model, DDM. I would have also talked about dividend discount model. Say where the only form of return that we are getting is typically the dividends. And that is all what is the kind of return what you have, and that is what we discount. Typically, if you look at any of the, in reality, if you're looking at investing in a public sector stock, not really the appreciation, stock price doesn't appreciate much, but you are getting a constant, real good dividend in the process out there. So that is the kind of investment what we are looking. Safe investments in the process. An example could be, off the cuff could be recently NMDC and things like that.
So when we do the valuation, if we keep on adding the net retained earning year after year after, certain value arrive at. Based on that, we do the valuation of the company. But market valuation is totally different.
Market valuation is different, sir, because market value is also looking at the various other factors. That the market value is when you're looking at typically the market cap, that is the share, what is the value of the equity share in the market, multiply with the number of equity shares, the number of outstanding shares, and that is the value of the company, and so on and so forth. but that also keeps fluctuating. For example, today, if you look at this, everything is in a bull run and then the valuation will be very, very high. But there are times when there is a bearish market, the market valuation could be lower than the book valuation, what you will have also. And market valuation is for what you call it, is not for the sale or purchase of the entire company. It is for sale or purchase of the equity portion that you are holding. So the value could be could seem higher in the process, but if the entire entity is up for sale, then the valuation will not be like this. Valuation will certainly come down in the process of even in the market. Our valuation is based on what is the earning potential of the firm out there. That is, we are not looking at valuation based on the retained earnings. We are looking at valuation based on the future expected projections of the firm, cash flows of the firm. Based on the future expected cash flows of the firm, I discount the cash flows of the firm that is going to be there in future and then arrive at a value, and that is the valuation of the firm what I am talking about. Normally, in reality, if the market is stable, if the market is not in a bull run or a bearish run, the market is stable, then these two values, the projected value what you will have, as well as the market value, should more or less nearly be the same.
Yeah, when a company goes for an IPO, there are a lot of bank offer this as service to do the valuation of the company based on which the IPO price range is decided.
Yeah.
But in reality, of course, because of market sentiment, people try to pay far higher. But even then, company to company, two evaluators may not arrive at the same valuation.
Of course, yes. Two evaluators will not arrive at the same. That is one of the reasons we always look at a range of values, number one. And when we talk about market, the timing in the market is extremely important when you come out with an IPO. No IPOs will come when the market is in a bearish run. IPOs will come only when market is on a bullish run. That is when your valuations are going to be far, far higher. Your discounting will be lower and then far, far higher. So, I mean, value is always, if I have to go back to the same saying, value is always in the eyes of the beholder. So, how much, I mean, a firm might value their assets and their potential, future earning potential to be X. But personally, I may not value it the same. So I may not even invest in that particular company out there. I might just wait and then for a better opportunity or so on and so forth. So this valuation is always what you call it, as a beautiful game, which the companies play. That is where timing in the market is always important out there. There are companies in the history, if you look at, there are companies which have cancelled the IPO just one day before the launch, because one day before the launch, the market would have crashed very badly. And just 1 or 2 days before the launch, the market would have crashed, and there are companies who have pulled back their IPOs because they don't want to get to the market now, because they know that they cannot get the value what they have indicated there.
I agree, sir. Except that I agree, but when the banking services, evaluate a company before pre-IPO to fix the price range, there are some regulatory guidelines. They can't just put fancy price because of sentiments.
Sir, the regulatory guidelines in terms of the formula for capital, controller of capital issues, etc., that was abolished in 1992. And after that, controller of capital issues are not there. Companies are relatively free to price, because as long as they are able to justify the kind of cash flows what they have projected. Of course, I agree, they cannot come up with a fancy price out there, but as long as the projections look reasonably okay, reasonably viable, reasonably with a very valid or a reasonable assumption, then companies can come up with this. That is one of the reasons some companies after the IPO bomb very badly. So Lakan, I think screen calculators is what is to be used. I am not sure if they would allow you to carry rough paper. I don't think they would. If required, they might provide.
They give a paper, sir. I have attended similar exams before. They give a paper.
They give everything. So you don't have to carry a paper. The screen-based calculator should be okay. I think it will be in a TCS center, one of those. So valuation is a completely different ballgame. In fact, very simple, sir. You might say, I will discount it at, say, 16%. One of the other merchant banker will say, I will discount it at 16.20%. Your valuation will be completely different. All you say is 0.2% is what the discounting changes. Discounting. I'm going to project cash flows for 10 years and I'm going to discount this cash flow to today's value, and the 0.1% or 0.2% of discounting rate change will make a lot of difference. Simple. When I make a projection, my projected cash flows, my projected sales, you take it at 5%, I take it at 4.8%. My cash flows will vary. My, what do you call it as, my valuations will vary. That is one of the reasons valuation is always a lot of subjectivity gets involved in the process.
So when after an IPO, let's say the book value, face value is 10 rupees, and it is priced at 540 rupees, let's say. And when it's fully subscribed, the share capital will show the value of 10 rupees plus how they will account the premium part.
Yeah, premium will be part of my reserves and surplus, sir. Premium will be part of my reserves and surplus. Supposing I have 100 shares as of today, and I am going to raise the capital 1,000. So my total share capital is 1,100 shares into 10 rupees. On the 1,000 shares, what I've issued, I imagine I collected a 30 rupees premium per share. So 30 into 1,000 will be my share premium. So total capital, total value of my total net worth or total capital is 1,100 into 10 plus 1,000 into 30. So that will be my total share capital out there. And what is my book value? 1,100 into 10 plus 1,000 into 30 divided, the whole thing divided by 1,100. That will be part of your reserves and surplus. Share premium. Because that money belongs to all the shareholders. The new shareholders who have bought it at that price, as well as the existing shareholders, because who have taken the higher risk in the initial stage, and they also need to be compensated for the risk what they have taken. That is why you are buying it at a higher price.
So that brings us to the fundamental question. As a shareholder, not a promoter shareholder, let's say we are a minority stakeholder. Do I prefer a higher debt or higher equity?
Well, that depends on the performance of the company, sir. If the company is extremely performing well, the cash flows are very good, I would prefer higher equity. I would not prefer debt. Higher debt, I would prefer as an investor. I'm going to invest in a debt only if I want a very safe return, etc. But as an equity investor, I will look at company where equity is higher, not debt. Because moment debt is there, a lot of chunk of money just goes off to the debt provider. For example, you look at any of the IT stocks, there will be no debt, completely equity. Unless there is use of debt, there is no point in going for debt. Refinery, yes, high debt, because use of debt is very high.
I'll wait for your follow-up course on valuation, sir.
Sure, sir. You have to wait for some more time. I think I'm not even started recording. I think I'll do it. I think Suhail has to help me out, and we'll do it, sir. I'll keep you posted. I think Suhail is in touch with you already. So that is what he said. So I'll ask him to post it moment it is ready. Any other question? Maybe I can hold for 10 more minutes, no problem. I mean, I can be here till 7:30, not an issue. If there are no questions, I can hold for 10 more minutes. Yes, Kavya. So is it time limit for each section or total duration? There's no time limit for each section. No time limit for each section. Oh, total duration. The each section I have given because I taught the course in 3 parts. I have given this time slot in 3. I've given the questions in 3 parts. It's exactly on the same pattern as the assignments that you can take it from me.
So, sir, there would be only 20 questions in the whole exam. You mean to say?
No. There are 54 questions totally.
54.
8 questions, 6 to 8 questions per
Concept
day
based.
for all the 3 sections. In each of the 3 sections, 6 to 8 questions, 1 mark each. In each of the section, 12 questions, 3 marks each. So right there, 36 plus 24, that is almost about 52 questions, right? 53 questions totally. I think financial accounting, 6 and 12, right?
6 and 12.
6, 1 mark, 12, 3 marks. And there's one question which is fill in the blanks kind of a thing in financial accounting, that is 4 marks. And cost accounting, 8 and
6 question period. And
6,
12.
12. Yeah, 6 and 12. Same thing with financial also.
Yes, 6 period.
6 and 12. Yeah. 52.
Thank you, sir.
Come. I hope the course was useful in terms of some value add. That is what I thought when I designed this.
Yes, sir. I think as a foundation course, it was quite useful. I found it very extremely useful.
Thank you,
Though
sir.
many times we have been using these terms very freely, and a lot of concepts got cleared. As a
Thank you, sir.
foundation course, I got really benefited, sir.
Yes, sir. It's a foundation course. What you said is perfectly right. It's a foundation course. That is where all 3 the aspects are mixed together and brought out as one. It's a foundation level course. Yes, thank you. That is the objective. Objective is to make people more comfortable with the terminologies and the basic concepts. That's all. I did not aim for anything higher than that. Thank
Sir,
you.
one more question on discounting rate.
Sure, sir.
In reality, how is the discounting rate arrived at? Because I mean, one is the expected rate, another one is the rate what you would have probably paid for if you are putting in an alternate safer investment. But in reality, how do finance managers arrive at the discounting rate? Because that would decide a project validity or not.
Sir, discounting rate is always the cost of capital for a project. What is my expected cost of capital for this project? That is what is the basic discounting rate. That is what forms the discounting rate out there. They have to make an assessment at what is the rate. For example, imagine I have a combination of debt and equity, say 30% equity and 70% debt, 70% equity and 30% debt. I should be able to assess at what cost will I be able to raise debt And if this is the kind of equity, then assessing the risk, the credit risk, the financial risk, the group risk, the business risk, the market risk, all this, assessing all this risk. What is the expected cost of capital for cost of equity for me? That should be there, because I look at comparable companies and at what price, what is their expected return, expected cost of equity. So I will take that as a proxy. Then I will say, what is my expected cost of capital? And that expected cost of capital will be my discounting rate. Again, to repeat, to conclude, before I conclude, it cannot be just one simple number. If somebody says my cost of capital is 17% period, no, it cannot. It will always be a small range that will be happen, because the cost of capital will also vary with the market conditions. And for example, your RBI's monetary policy and so on and so forth out there. So there will be very a small range in the process, and that is how your discounting rate is decided. Am I with you, sir? Did I address your query, sir?
Yes, sir. Thanks, sir. I think that clarified. I just wanted to know whether inflation has got any role to play. I think indirectly through RBI
Indirectly,
policy.
yes. Inflation, monetary policy, everything has a role to play. Your prevailing interest rates in the market, for example, 5 years back, the interest rates are very low. Today, interest rates are very different. So what happens? I should be able to foresee and take a call on all that. So that is where we always look at the future. So there are what is called as industry reports available. And most of these reports will sort of give you some idea about it. And that is what forms the basis. That is how investment bankers start off their job itself. And that's where they go wrong also. There are a number of cases where their assessments have gone wrong, and which can really push the company into whatever. Any other question? As we can sort of think of maybe closing in the next 1 or 2 few minutes. Okay, then if we have no questions, I think we will sort of wind up. And thank you very much for opting for this course. And I take your feedback very seriously. and I will try and see if I can make some changes for the next session if then this course is launched. And thank you very much. You can always be in touch with me. I have provided my email ID and everything, so you can be in touch with me. And all the best. Thank you very much. Thank you.
Thank you, sir.
Thank you. Thank you, sir. Thank you very much. Thank you.